your bank balance went up this year, and you still got poorer. Both of those are true, and almost nobody notices the second one. The savings account you were told was the safe, responsible choice has two quiet leaks in it. You have been paying for both without seeing either. Start with the thing to unlearn. When you put money in a savings account, you are not storing it in a vault. You are lending it to the bank at a rate you would never accept from anyone else. So you are not really the saver in this story. You are the lender, the bank's cheapest lender. And by the end of this, you will see why the account that feels the most responsible can be the one quietly costing you the most. The fix is not a stock tip. It is a way of looking at every dollar you hold. Let me show you the two leaks. Picture two people. One leaves cash in a default account. The other moves it to a high-yield account. Watch them both, because here is the quiet part. Both are still lending the bank their money. They are just doing it at different speeds. Neither one is in a vault. Leak 1. The spread. This one is the bank's cut, and it is built into the whole system. When your deposit lands, the bank does not let it sit. It puts your money to work that same day. It lends it out to people carrying credit card balances, to mortgages, or it parks it in short-term government bonds. As of mid-2026, the FDIC put the national average savings rate at about 0.38%. Park $20,000 at that average rate, and you earn about $76 for the whole year. $76. While the bank can put that same deposit to work at several times the rate it pays you. How much more? Across U.S. banks, the average net interest margin was about 3.3% in early 2026. That margin is just the gap between what a bank earns on money and what it pays for it. Your deposit is the cheap side of that gap. Put it in plain terms. The average credit card charged over 22% to people carrying a balance in 2026. Some of that borrowed money is effectively yours. Lent back out, using the deposit you were paid 0.38% for. Even the safe route pays the bank. Short-term treasury bills were yielding roughly 3.7% in mid-2026. The bank can hold your deposit there and simply keep the difference. That difference is the spread. That is leak 1. And the rate stays low for one reason. Most people never move their money. That inertia is the product the bank is quietly counting on. Inertia is not free either. U.S. households paid an estimated $12 billion in overdraft and related fees in 2024, according to the Financial Health Network. But here is the thing. The bank's cut is the small leak. The bigger one you are doing to yourself. And it hides inside a number that is going up. Leak 2 hides in plain sight. And this is where the ice cube comes in. Picture your idle cash as that cube. It looks solid. The number painted on the outside even grows a little each year. But inflation melts the real value, drip by drip. What the cube can actually buy keeps shrinking, even as the number ticks up. Here is the melt, measured. In June 2026, prices were up 3.5% from a year earlier. The average savings account paid about 0.38%. So in real terms, that money lost roughly 3% of its buying power over the year. Even though the balance looked bigger, the number went up, the cube got smaller. Both true at once. There is a name for this. Real yield. It is simply your rate minus inflation. When the rate sits below inflation, real yield is negative, and the cube is melting. At 0.38% against 3.5% inflation, the average account is not slowly winning. It is quietly, steadily behind. And we have not even taken the tax out yet. Savings interest is taxed as ordinary income, the same brackets as your paycheck, not the lower rates that apply to long-term investment gains. Worth knowing the contrast. Interest on treasury bonds is exempt from state and local income tax. Savings interest is not. So your savings interest gets taxed at your full rate, from the other side. The melt speeds up. Now the high-yield saver, the second person. Surely they escape all this. After inflation and then tax, even a strong rate can land close to zero in real terms. And watch the fine print. Many eye-catching up-to rates are tiered or temporary. The top rate can apply only to a slice of your balance or expire after a promotional window. So far, this sounds like savings accounts are a scam. They are not. Here is the part that flips it back, and it is the part that actually helps you. Cash has a job. A real important one. It is your buffer. The money that stands between you and a bad week. Your cash is insured by the FDIC up to $250,000 per depositor, per bank, per ownership category. That is real safety. Safe from the bank failing. Safe from the number ever dropping to zero on its own. But that is only one kind of safety. And this next line is the whole video. Safe from the number dropping is not the same as safe from losing value. A savings account gives you the first. It cannot give you the second. There are two risks here, not one. The risk of the number falling and the risk of the value quietly melting. Savings removes the first. Savings is the second. So for your buffer, the melt is fine. It is the price of keeping that money instant, certain, and there the day you need it. Call it the insurance premium. The mistake was never having savings. The mistake is leaving money in the cube for years, when that money has no near-term job at all. So if the answer is not, pull all your money out, then what is it? It comes down to three questions you ask about every dollar you hold. Question 1. Does this cash have a job in the next year or two? A rent cushion, a planned expense, the emergency buffer? If yes, keep it right where it is. That is the buffer doing its work, and the melt is just the premium you pay for it. Question 2. Is even that buffer earning the going rate, or is it sitting at the default 0.38% out of pure inertia? Because the difference between the average rate and the going rate is real money, and it cost you nothing but a little attention. Question 3. The rest. The money with no job in the next year or two. Is it melting in the cube, or is it working? That is the whole question. Not which account, not which tip. Just, does this dollar have a job, and is it doing it? There is even a name for what idle cash beyond your buffer costs you. Opportunity cost. What that money could have been doing instead. And this is the part worth sitting with. The account that feels the most responsible is quietly the most expensive place to leave money that has no near-term job. If that reframe just landed, subscribe. The honest version of this is rare. So come back to the cube. A cube in your hand for a week is fine. That melt is the price of safety, and it is worth paying. But a cube you are saving for 10 years is not a plan. It is a puddle you have not noticed yet. The number on the outside kept you calm. The melt on the inside kept going. Safe was never the wrong instinct. It was just pointed at the wrong risk. So here is the one thing to do. Look at your cash and split it in two. The part with a job soon, and the part just sitting there. You do not have to move a thing today. Just see it clearly, which is already more than most people ever do. If this changed how the word safe sounds to you, subscribe so the next one finds you. And if you want to understand the force doing the melting, watch the one on inflation next, where we follow a single dollar as it quietly loses its value. See you there.